Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Duggal. Let's get you the headlines. Benchmark indices are trading near the day's lows, dragged down by select metal, stocks and private banks.
Wholesale inflation in India eases more than expected to 3.8% in December.
Auto sales decline across the board in December. According to data from SIAM, medium and heavy commercial vehicles are the worst hit.
Infosys jumps over 2% in trade today after the management raises FY19 constant currency revenue growth guidance to 8.5% to 9%.
And Avenue Supermart reports its slowest profit growth in nearly 8 quarters. Discounts and longer operating hours during the festive season may have hurt margins.
Quick check on how the markets are faring right now. They are being dragged down at their day's lows, led or rather dragged really by the metal counters. Yatin is here with a closer look at what's going on.
Clearly, Harsha, and we are at the day's low, nearing that 10,700 mark on the Nifty. So we are almost 100 points down in trade today, with the advance decline ratio at almost 8 advances to 41 declines on the Nifty. So clearly, not looking that great in terms of the market breadth. What's pushing the market lower is, stocks like GAIL, Wipro, L&T, IndusInd Bank. And remember, IndusInd Bank post the earnings has seen a slide from levels of 1700 to a level of almost sub 1500 today. Good profit taking is what we are looking at IndusInd Bank post the numbers. What is doing well in trade is Yes Bank, and stock is up nearly 5% in trade. Infosys, of course, after the management raise guidance, is up 2.5%, quite stable, in terms of the stock performance for Infosys today. What's not doing well again is the likes of TCS. DMA is down 10% after reporting dismal third quarter earnings. We also have Praj Industries as well as the likes of Federal Bank, which are in focus. Praj at record highs, and Federal Bank, after the executive director resigned, is down nearly 5% in trade, making it the worst performing F&O stock in trade today.
All right, thanks so much for that, Yatin. Auto sales declined across the board in December as per data from the Society of Indian Automobile Manufacturers, or SIAM. Though it's a seasonally weak month for automakers, the sales were much worse than usual this time around. Yatin's still with us. He'll give us perspective on that. Yatin, what went wrong?
Well, if you look at the overall trend in the industry, the passenger vehicle segment and the commercial vehicle segment were the worst hit, when the sales almost being flat for the passenger vehicle business in the domestic market. The sales were down nearly 0.5% for that segment, with the utility vehicle sales declining by nearly 2.3%. If you look at the commercial vehicle sales also, we have seen a 8% decline there, and especially in the medium and heavy commercial vehicle segment, wherein the decline is much sharper at 21%. Clearly the tippers and the heavy trucks, which is basically a 33-35 ton plus segment, has seen some good decline. Similar is the case with the two-wheeler segment. Of course, rural demand remains buoyant, but on an overall basis, we have seen a decline of nearly 2% for the domestic two-wheeler sales. However, we have seen the scooter sales decline at a faster pace at almost 7.5% this December. Across the board, there has been weakness. However, we have the SIAM president, Rajan Vadhera, when he was speaking to Bloomberg Quint, he said that the fall in the medium and heavy commercial vehicle sales in October-December period is largely to do with the confusion regarding the axle norms and higher insurance costs. Clearly, they say that it's a temporary blip, and we could see some good sales coming in starting the Jan to March quarter.
Okay, Yatin, thank you for that. Let's move on. Inflation in India continued to soften in December. Wholesale prices index rose about 3.8% versus 4.64 in November. That's the lowest than the 4.51 estimated in the Bloomberg survey. We're also watching out for consumer price data later in the evening. A Bloomberg survey of economists pegged retail inflation at 2.2% in December as against 2.33 in November. This, combined with slowing growth indicators like IIP that came in at a 17-month low at 0.5% in November, strengthen the case for easier monetary policy. Joining us now to put this in context is Subhra Rao, Group President and Chief Economist at Yes Bank. Subhra, thank you so much for joining us on the show. Firstly, what is the inference that you're drawing from the slowing inflation numbers, the slowing IIP industrial growth numbers? Do you expect the RBI to, in a sense, re-examine its own growth narrative?
I would think so, because particularly against the backdrop of inflation and the softening momentum seen therein, both predominantly in the led by consumer price indices. I think the previous 2 months, I mean, including this month, last month was 2.33. This month we are anticipating a 2.11. Clearly, it shows a waning impact of some of the demand-led pressures. We are seeing softer consumption demand. Fuel prices and fuel indices are expected to track in lower momentum. Given these factors, I think we are looking at end March inflation somewhere close to 3 to 3.5 band, and on an average basis for the current fiscal year, it could be well around 3.5 to 3.8. Given this backdrop and what we discussed earlier, what you talked of earlier in terms of industrial production numbers being softer, and our earlier interaction on the Bloomberg Quint, where we had said that second half of the current fiscal year has been seeing a softer growth momentum, should hopefully pave way for RBI not just resting at changing the stance from calibrated tightening to neutral, but given the foreseeable trajectory on inflation led by CPI particularly, the case could jolly well be that of lowering the interest rates.
Shubhda, slightly backward-looking question. I know that the RBI or the MPC will be looking forward in deciding how they move on rates. But there is something to be said that, we have gotten this inflation story wrong for the entire year. If one looks at how the numbers have played out, perhaps there was no need for tightening in the current year.
I would think at least the change of stance was something that was perhaps jumping the gun, because most of the analysts were also actually seeing inflation forecasts being lowered sequentially at least twice over, including ourselves. We ourselves had lowered our inflation forecast twice earlier, looking at the softer momentum. Of course, we had a blip in October, predominantly led by the fuel prices. But barring that, if you look at the demand conditions and demand-led pressures on core inflation, as also in terms of primary inflation, particularly led through perishables, the overall trajectory was not looking beyond comfort enough to warrant a very calibrated tightening. But to be fair, I think we live in a highly uncertain world, and October was also the time where we were seeing a significant flare-up in the fuel prices, in the crude oil prices internationally. We were not sure of the onset of winter having its impact on the food prices particularly. All of this has fortunately played out in the favor of analysts calling a lower inflation numbers. So I would think that having a rear view mirror is sometimes easy, but we live in a volatile world, so it's possible that you err on the side of the caution rather than get adventurous. But yes, calibrated tightening, a neutral stance would have helped, because it helps the central bank work in either direction, particularly when you are heading into uncertainties. So notwithstanding the change of stance, probably February is the time where you look at recalibrating your stance to neutral. I am not too sure whether the change in stance as well as a rate cut can happen in the same policy statement, but the situation perhaps warrants a rate cut. Though earlier I would like to also say that it's not just rate cut. I think in recent times we've seen addressing of liquidity conditions has gained importance, and even if RBI continues to talk up the liquidity, of course partly through actions and partly through changing the sentiment,
right,
that alone should also help. Probably a rate cut could wait until later.
Okay. I want to push the point about industrial production just a little more, Shubhda. At 0.5%, it was obviously much lower than what was anticipated, albeit it was on a higher base previous year. But what is the sense that you're getting from whatever different data points that you're reading of industrial growth and sentiment in industry? I'm referring to some of the CMI data also suggesting that there is a trend weakness. And is that weakness likely to continue?
Yes, I think, of course, the 0.5, in my opinion, was an aberration, Harsha, because there were three factors which were playing out. One was obviously the statistical base. The second was the unwinding of the momentum that builds up around the festive season, and subsequent, post-festive month, you see an unwinding momentum creep in. So that, as well as, what we had seen in the domestic financing conditions. So all these three factors did play a role in IIP looking extremely anemic. But if I dissect the growth numbers more closely, particularly from the perspective of consumption and investment, yes, consumption demand has been on the moderating side of the momentum, both the urban and rural demand. Urban demand, mainly if you look at proxy indicators like, automobile sales, or you look at air passenger traffic, those have been softening. And of course, we have heard enough on the rural demand softening, corroborated by two-wheeler sales and so on. I think altogether we have seen softening in consumption demand. So second half will reflect that softening momentum to continue. But also enough attention should be paid to what's happening to the investment demand. I don't think the story is that bad in investment demand side, because while definitely central government may have been lowering its capex spending because of the fiscal constraints, what we see is a private sector appetite is not too bad. You look at capacity utilization levels, you look at real estate, real activity indicators, all these factors have had some indication in terms of improving investment demand going forward. Of course, IIP did not corroborate on the capital goods production, which came in negative, but if I look at import of capital goods and so on, all of these proxy indicators do suggest that investment demand may be actually getting better. In nutshell, therefore, it's kind of a mixed picture, but if I were to put it in time horizon, definitely the first half of the current fiscal year was much stronger. Second half, we will see softening in overall growth, essentially being led by softening of consumption.
Shubhra, sorry, just coming back for a last word on inflation, because we'll get the CPI numbers later today. Is there any sign that the momentum on food prices is turning? Are we starting to see any pickup at all in food prices based on the indicators you track?
Actually, no, because we are looking at the CPI today at 2.11, essentially being led by food prices. Food and housing would be two factors, two subcomponents that we will look at, which show contraction. Food prices will, in our estimate, contract by 1, essentially being led by vegetable prices, which high frequency indicators seem to suggest that they are going to be contracting by as much as 12%. Winter months are typically great for the perishable items, momentum coming in much lower, and that's exactly in our estimation is going to get reflected in the CPI food inflation too. So overall, if I dissect the components, we see food showing a contraction, we see fuel obviously showing contraction, miscellaneous also probably will contract, and also if I look at housing is more of June-December phenomenon, where we see housing inflation typically goes into contraction in the month of June, and in the month of December, it's more of the behavioral seasonal pattern. But overall, coming to your question specific, I think food definitely will continue to decelerate, and that should provide a fair amount of support for the CPI to come in lower. Not just in the current month, it could also feed into another month, because what we are seeing is an extended period of winter, and that could remain supportive of food prices remaining much lower. So that is the reason why we are looking at if I look at the CPI trajectory between now and March, it shows that for end March, in our quick estimation, it's showing somewhere close to 3.2. That is well possible if crude prices do not flare up internationally and remain in the current band, and also because unlikely the demand pressures will continue to flare up. One point that perhaps I needed to add to that, one one evidence that we would be watching out for some recovery in consumption would be election-related spending. The timing of election dates could well, on a backward-looking momentum, show some consumption recovery, but overall it could remain soft. So if I were to add the CPI prices remaining, CPI inflation remaining somewhere close to 3.25% for end March, and on an average somewhere close to 3.5, 3.8 band, it sort of creates a way forward for monetary policy action to take shape, which we will know shortly. But I would think that the trajectory itself should provide larger comfort going forward.
Okay, Shubhda, we'll leave it there. Thank you so much, Neel, for joining us with your perspective. Shubhda Rao, Chief Economist from Yes Bank, talking about inflation forecasts and industrial production. Infosys, meanwhile, has followed in TCS's footsteps to report a significant margin contraction in the December quarter. But the management is not worried. Salil Parekh and his team have raised their revenue guidance for the full financial year while maintaining the margin expectations. Agam is here to sum up the quarter gone by.
Well, I'm going to start off with the guidance because that clearly is the highlight for this particular quarter. The guidance has been revised upwards to around 8.5% to 9% against 6 to 8%. And this is a significant upward revision, which is why the stock is currently trending higher. Of course, as far as margins are concerned, the management maintains and keeps the margins guidance at around 22 to 24%. But let's also take a look at how the quarters panned out. Of course, there is a deal momentum and they've won deals worth around $1.5 billion now, and these are new deals into the system over the last 9 months. With respect to revenues, we've seen a 2.3% uptick in dollar revenues, and that was largely in line with street expectations. Perhaps the surprise came in on the margins front because the contraction in margins was much more as compared to what the street was working with. About 110 basis points margins cut coming in. Of course, we also have to understand that they have adjusted for, to a certain extent, the valuation, the revision for Panaya and Skava. So let's take a look at the margins picture and where we've seen that contraction coming through. Depreciation given for Panaya and Skava, acquisitions, of course, lower utilizations on the other hand, higher compensation costs have also added and continued investments. On the other hand, we do have some amount of tailwinds from currency benefits and lower leaves, and which is why that comes that's the reason why we're looking at about 110 basis points cut on margins. Consequently, profits dropped 12% sequentially as well at around 3,600 crores. Now, when it comes to this buyback, we did see the buyback price come in at around 800 rupees per share, which is much higher than what the street was working with, which was around 700 to 750 rupees per share. And the total quantum for the buyback is around 8,260. One might ask, why is this number looking so small? That is because they are also applying and giving out a special dividend, about 4 rupees each, and that payout comes to around 2,100 rupees, or rather 2,100 crores. But moving in and talking about the segments too, its largest vertical, financial services, has seen a 3.6% growth, and this is much higher than what TCS saw, which was a little less than 1%. And of course, retail continues to remain flat at this point in time, but that volatility was more or less anticipated. In terms of geographies, again, that recovery in North American regions continues, even as we see a 2.6% uptick sequentially, and Europe, of course, going from strength to strength, around 3.8% uptick there as well. So while we do have a lot of strength in North America and Europe, we've also seen that sustenance of growth in your larger verticals. Perhaps some amount of concerns coming in margins, but given the fact that the management has upped their guidance, that's of course a positive for Infosys.
All right, Agam, thanks so much for that. The festive season ends up taking a toll on Avenue Supermarts. The cost of discounts and extra working hours hurt the profitability of DMart retail chain. Darshan Mehta is standing by with a closer look at the numbers. Darshan.
So what happened is numbers missed all the estimates, even they fell. Actually, the rise wasn't there, and compared to the Bloomberg estimates, the numbers were much lower. If you're looking at the top line growth was 33%. That came in lower than the estimate of what Bloomberg had. EBITDA growth of 7.5% came in at 453 crores versus the estimate of 490 crores. EBIT margins actually fell in 200 basis points, and PAT growth was just 2%. So these are some of the important factors that happened, and that is why DMart was down almost 9% in trade. Some of the reasons why the slowdown did manage to happen. First of all, the profit growth was just 2%. Margins were down 200 basis points. Decline in other income and higher depreciation expenses also hit the number, and the gross numbers were also lower. Some things that added the revenue growth was clearly there. So firstly, low cost pricing strategy is something that drove revenue for the company, and they added new stores, so the store count was much higher. That added to the numbers. What hurt the margins? First of all, the price cut during the festive season was something that the company said impacted the numbers. Secondly, they overspent on longer operating hours this time around. The inventory built up for the earnings season or for the festive season was much higher, and there was higher investment in infrastructure and people, and that is something that impacted the numbers. As far as valuation is concerned, the valuation is in excess of 80 times, and at this valuation there is no scope for error, and because of this miss that came in, the counter has corrected 10%. Most of the analysts actually now have an underperformed rating on DMart. Most of them have indicated that they're concerned and cut the EPS estimates because of poor set of numbers in the third quarter.
All right, Darshan, thank you for that. That's DMart for you. The government may turn to its Sooty stake to meet divestment target. That's according to PTI. While it may resort to off-market deals for its stake sale in ITC and Axis Bank, the government will wait for L&T's buyback to tender its shares. So exactly how much money can come into the exchequer through this route? Sajid has done some math. Sajid.
That's right, Harsha. If you look at what Sooty holds, the three stocks which it holds, ITC, Axis and L&T, together account for nearly 48,000 crores in value, and that's nearly 99% of the total portfolio of Sooty there. Within that, ITC, which is in which Sooty holds nearly 8%, is valued at nearly 29,000, and Axis is valued at nearly 16,000. L&T is a small stake which they have of 1.8%, which is valued at 3,400, where the government is looking to participate in the buyback of L&T, because L&T came out with a buyback offer of 1475 for up to 9,000 crores. So we don't know how much government will participate in the L&T, but there is a chance that they will try to benefit from it, because the current market price of L&T is much lower than the buyback price which is there. But the fact is that in the last 18 months, government hasn't tapped Sooty. We've been hearing about that government may sell Sooty stake over a period of time. The last they sold was in 2016-17, when they sold marginally in both Axis and Axis L&T, and some bit in ITC they sold. But that is something which is going to be a key factor for the government, because they will have currently, if you look at the divestment target of 80,000 crores, they have done 34,000 odd crores by December end, and they have another 15,000 crores which they can get from buybacks, and another 15,000 crores from REC PFC deal which is there. So you still have nearly 15 to 20,000 crores of deficit in the divestment target, which can come in via Sooty stake sale.
All right, Sajid, thanks so much for that. Ola has just got a new investor. Flipkart co-founder Sachin Bansal has decided to bet on the homegrown cab aggregator. Nishant Sharma joins us with the details. Nishant, how much is Sachin investing?
Well, right, Ira. So Sachin Bansal, the co-founder of Flipkart, is putting in about close to 149 crores in India's ride-hailing platform, Ola. As per the filings made to the register of companies, as per the filings made, this deal is a part of the Series J transaction, where Ola has allotted about 70,588 preference shares to Bansal at a price of about 21,250 per share, as per the filings. Now, this round also comes just a week after Ola raised about close to $74 million from its existing investor, Steadview Capital. Now, the pricing for both the deals are same, and that values Ola as about close to about $5.7 billion. Now, Bansal, who quit Flipkart just a day after the announcement of the Walmart deal with Flipkart, has made close to about $1 billion by selling its 5% stake in the company, and has been, scouting for investors, investments. He was using $1 billion in the market. Most recently, he set up his own venture fund, such as BAC Acquisitions Private Limited, along with the help of his former IIT Delhi batchmate Ankit Agrawal. That's also according to the filings made to the ROC. And that acquisition arms will look at certain areas such as agriculture, health, media, to name a few. But Sachin is back as an investor again, and back with the first investment in Ola.
Nishant, thank you so much for that. Out of time on the show, thank you so much for joining us today.
Lots more on Bloomberg Quint. Stay tuned.